Okay, welcome again. This time round we are going to tackle question 2b. Question 2b of CPA Financial Accounting Section 1. This is May 2021. May 2021 KASNEB paper. So CPA Financial Accounting Section 1, May 2021 KASNEB paper. So this is question 2, but we're interested in question 2b. And question 2b is on it's about depreciation, and we are supposed to come up with an asset, basically a schedule, a PPE schedule from 1st January 2011 up to 31st December 2020 with those details. The details: date of purchase, cost, annual depreciation, accumulated depreciation, and the net book value. So the following details relate to machines. Of course, you can see we have machine A, machine B, machine C, machine D, and machine E with their cost and the date of purchase. And those are the particulars. So let's go straight into working. And this will be our worksheet. So we'll have solution and then start right away. So part A has the date of purchase and the cost. Part B, I think this is where our focus should be, and part C is what is required of us. So agency contractors depreciation policy as follows: machine A and B are depreciated on a straight line basis with no scrap value over 10 years. Machine C is depreciated on a reducing balance basis at 20% per annum with a scrap value of 5 million. Then machine D and E are depreciated on straight line basis with over 5 years with scrap value of 10% of the original cost. Well, these are this is quite good questions. Testing on the straight line method with no scrap value, straight line basis, the straight line method with scrap value, and reducing balance method with scrap value. Those are the three things that are being tested here, and of course you have to know how to come up with a schedule that captures all these things. So we'll go straight into workings, after which we'll prepare now the schedule. So we'll start with machine A and B. Machine A is 26,000, machine B 12,000, 15,000, and all of them are depreciated on straight line basis with no scrap value for 10 years. No scrap value, 10 years. Okay, so we start with machine A. Let's go step by step. So machine A and straight line method of depreciation, straight line depreciation. The formula is normally the formula is the cost minus the salvage value over the number of years in useful life. This is the formula. Or sometimes if we are given the percentage, you simply work out the percentage of cost minus salvage value. Salvage value is the value that remains at after the useful life of the machine. That is the formula. So for machine A, we've been told it was purchased at 26,000. Let's just work with thousands. 26,000, and it has no scrap value, and it has a useful life of 10 years. So this one is quite straightforward. For machine A, you simply take our cost is 26,000 over no salvage value, so minus 0 over number of years in useful life, that is 2,000. So every year, annual depreciation for its entire useful life, that is 10 years, will be 2,600. And that should be the same case also with machine B. Machine B is 15,000. So it's the same case. Machine B, it follows the same machine B, which is following the same formula. It will be 15,000 which is the cost minus salvage value, which is 0, and it's supposed to have a useful life of 10 years. So every year it will be depreciating by 1,500. This information will be captured in the schedule. Then we go to machine C. Machine C will be we'll call for a bit of some workings, because this one is 47,500, and we've been told that it has a machine C is depreciated on a reducing balance basis at 20% per annum with a scrap value of 5 million. Let's talk with 5,000 because we have chosen to restrict the zeros. So that means it has a scrap value of 5,000 and reducing balance and 20% per annum. So machine C, this is reducing balance method. It's a different method from machine C. It's a different method from straight line method. Reducing balance, we work with the written down value. So this will take the cost. The formula is still the cost minus salvage value, and then of course you multiply by the percentage that it's supposed to reduce. But this, the difference between reducing method and the straight line method is that reducing method uses the what we call the WDV, written down value. So we are going to keep on using the written down value of that year to work out the following year like that. And like straight line method, where once you get the straight line depreciation value, that is the same value that will apply for all the years. Basically, for straight line method, we have a constant. The depreciation figure is constant or fixed. But for the reducing balance method, the depreciation figure is not fixed, it's not constant, it keeps on changing. And it keeps on changing because we keep on changing the main variable, which is the cost of the asset. We work with the written down value. So we factor in the depreciations of all those subsequent years when calculating the depreciation for the respective year that we're dealing with. So we go, let's work it out. Machine C depreciated with a scrap value of 5 million and machine C value is 47,500. So this one will call for something like a schedule, let's just to get it the best way possible. Let's have something like a schedule that will guide us. I'm just drawing these lines, but I don't know if we are going to use them, just in case need arises for us to use them. Okay, I think let's work with those three. Those three can help us tackle this question like that. We have another one like that. This is machine C. Now we'll have the cost and then the depreciation and then the written down value. So the cost here is 46,500? Let's just check to confirm. The cost is 47,500. 47,500. And then the depreciation is, we've been told, is at the rate of 20%, and then the written down value. Now that's what we are looking for. But there's something here, that this reducing balance method, we are working using the reducing balance method, but it has what we call the salvage value, the residual value. That at the end of this asset's useful life, we'll still have some asset value that for 5,000 shillings. So we'll simply take 47,500 cost minus salvage value, which is 5,000, and this will give us 42,500. So it's this 42,500 that will be subjecting now to the 20% annual depreciation. So we simply work out, so let's have this 20% here, so that we don't have don't end up using a lot of space. So that we have this open for us. So we'll simply talk of 20% of that figure, 42,500, and that gives us 8,500. So 8,500, this is the first year, so we can have first year here. And then the written down value, of course, will be the cost, what we have here, 42,500 minus 8,500. 42,500 minus 8,500. So minus 42,500, that gives us 34,000. 34,000. 34,000. 34,000 like that. I wish this one was in an Excel so that we just run it downwards. It will have been easier, but because we are looking at an exam setup, let's just work it out. So, the second year, we don't work with this. We pick this, the written down value, which is 34,000, and then we work again 20% of 34,000, which I think will be 6,800. We don't need to go to the calculator for that. So plus 68, we get 27,200, 27,200. This is this minus this. That's what we are doing. And then this 27,200 will be the figure that will start us off for the third year. So times 0.2, you get 5440, like that. Then you less that from that, you get 27,200, you get 21,760, like that. Sorry, 21,760. Then we go to the fourth year. 21,760 will come there, times 0.2, and gives us 4352. Then minus 21,760, this gives us 17,408. 17,408. And since we've not been told how many years this asset is going to be to be around, its useful life, we've not been told that. So we'll keep on subjecting it to depreciation until the date that it will take. Now, I think what will help us in this question will be the examiner wants up to 31st December 2020. So we'll go up to 31st December 2020 and see what it has for us. But otherwise, if we had been told that it will be useful for, say, 4 years only, then in that case, at the end of the fourth year, we will subject the whole of this amount to depreciation because we have already factored in the 5,000. That was the residual. So, we will keep on going. So, we go to the fifth year. And fifth year, we have 17,408. So 17,408 times 0.2, that gives us 3,481.34,801.6, like that. So plus 17,408, we get 13,926.4. 13,926.4. We are simply subtracting this from this. And then in our sixth year, we'll go all the way. Don't worry, 926.4. We subject it to depreciation for that year, 2785. So 2785. I think let's avoid this, let's do away with this decimal. So I'll just pick it from there. So 13,926. This is minus 13,926. That is 11,140. I have ignored the decimals, 11,140. So we go to seventh year, 11,140. I hope you are seeing how the depreciation rates are changing. So 11,140 times 0.2, that gives us 2228. So 2228 plus 11,140. That is 8912. So 8912, like that. So in the eighth year, we'll have 8912. Subject it to 0.2. We have 8912 times 0.2. That gives us 1782. So 1782, less of course from that. 1782 minus 8912. We get 7130. 7130, like that. So it will keep on going. Ninth year, 7130. They have told us that it's depreciating at the rate of 20%. If it was straight line method, 20% simply means that its useful life is 5 years. Because it will depreciate 20%, 20, 20, 20, 20, and then it's over. But for depreciating balance method, it will go all the way, unless if they tell you how many years it's going to be in useful life. So 7130 times 0.2, 1426. So this is 1426. 1426 plus 7130. We have 574. 574, like that. So we could just keep on going. I hope by this time, because this machine was bought in, the machine was bought in 2014 and they want us to go up to 2020. So that should be pretty good. We have done our what is expected of us. So we can as well stop there. So this is machine C. And now let's go to machine D. Let me just fix my machine D over here. So machine D and E are depreciated on straight line basis over 5 years with their scrap value equal to 10% of the original cost. So 10% of the original cost. So machine D is 18,000. So machine D, the formula that you're going to use is the same formula because it's straight line method. So the cost is 18,000. We are using this same formula up here. So this is 18,000 minus salvage value they have told us is 10% of the original cost. 10% of 18,000 is 1,800 over 5 years. We've been told that it only has 5 years. So 18,000 minus 1,800 equals that. Divide by 5, we have 3240. So this machine will be depreciating at 3240 per annum. And then we go to machine E. Machine E is the same thing. So SLM is equals to, we get the cost for machine E. The cost for machine E is 110,000. 110,000. So we'll simply come here and say cost is 110,000 minus 11,000 over 5 years. This will give us 110,000 minus 11,000 is equal to that divided by 5 years. That gives us 19,800. 19,800 per annum. Good. So that is it. So we already know how much each machine will be depreciating at for every year. So the next thing is to prepare now this schedule. Come here and say the PPE schedule. PPE schedule. Of course, the name of the company is very important. If you can include it, it will serve a very important purpose. So PPE schedule, let's have our schedule now. We start right from there. And our PPE schedule should have at least how many companies? We are talking about, those are 5 companies. So I'm looking at company A, B, C, D, E. Company A, B, C, D, E. So you have it there. There we go. Trying to draw these lines. That is company A possibly. That is company B presumably. That is company C. That is company D. That is company E. Possibly this will be our totals, and you can leave a section there for workings. Then here we'll have what? Here we can have this section for the headings. I think it's a very important section. So let's just run it. Yeah, like that. So that is our schedule we are preparing. So you can have machine A, machine B, machine C, machine D, machine E, and then the total. And then here we can have now the particulars of the details, like that. So we're already preparing our schedule. We are already preparing our schedule. We are already preparing our schedule. So let's come here So machine A and B are depreciated on a straight line basis with no scrap value over 10 years. So machine A was bought in a full year's depreciation for each machine is provided in the year of purchase. So the year of purchase, a full year's depreciation is provided. Okay. So for machine A, 2011. So it means we are going to run this thing from 2011 to 2018. So let's start with the first year, 2011. So this will be 20. Let's call this 2011. Year 2011. So that under year 2011, we are going to have all these headings: date of purchase, cost, annual depreciation, accumulated depreciation, and net book value. So date of purchase, we will have date of purchase, then the cost, then the annual depreciation, then the accumulated depreciation, then the net book value, like that. I think I've gotten it right. Net book value, yeah, that's what the question wants, and it's for 10 years. So you simply come here and you start filling the details for 2011, 2012, up to 2020. That means that you need to be pretty fast. Details are not changing. So this is 2nd January 2011, 26,000. 2nd January 2011 for machine A. So 2nd January 2011, the cost is 26,000. Annual depreciation was 2,600. That is the annual depreciation. They don't need to put it in brackets. So let's just leave it like that. We just say annual depreciation 2,600. So accumulated depreciation will be 2,600 still. And then the net book value will be 26,000 minus the accumulated depreciation, which will give us 20. This is 26,000 minus 26, like that will give us 23,400. So I hope you understand everything, how we've gotten this. 26,000 is the cost from the question. Annual depreciation is worked it out here. It's the 10%, I think. 2,600, this figure here, this one. That's what we are working with. And then accumulated depreciation is depreciation over the years. For this one, it's still new. So this is the first year of its use. So 26 net book value is cost minus the accumulated depreciation. So for asset B, we don't have asset B in 2011. No, we don't have all these assets. So for the total, we will have cost is 26,000. Annual depreciation is 26. Accumulated depreciation is 26, and net book value is 23,400. This is for the year 2011. So we'll continue with that trend up to 2020. Continue with that trend up to 2020. So my lines are a bit stubborn. I hope I'm going to get them right. Yeah, we'll continue like that up to 2020. Don't get tired. So 2011, now we go to 2012. So 2012 again, we have date of purchase, cost, annual depreciation, then accumulated depreciation, and then net book value. This is for 2012. So we'll have again, this is still, we repeat the same information, 26,000, 2,600, but now accumulated depreciation will be 5,200. That is for this year. Remember, this is 2012. For last year, 26. For this year, 26. So that makes it 5,200. And then the net book value will now be 26,000 minus 5,200, which will give us 20,800, like that. And we still don't have B, don't have C, don't have D. So the totals here will still be 26,000, then 26, then 52, and 20,800. That's how we go about it. And you underline this one. So in 2012, this is how the books would look like. I bet you are enjoying. It's quite easy. Then we go to 2013, just like that. Go to 2013. 2013 will also have the date of purchase, cost, the accumulated depreciation, annual depreciation, accumulated depreciation, and the net book value. So we still have the same thing. Sorry, I'm starting with the wrong figure. This is 2111, that is the debt, and then 26,000. Annual depreciation is still 26. Remember I said that this will apply throughout. Accumulated depreciation will now be this 52 plus 26, 52 plus 26, 52 plus 26. The accumulated, it's actually 52 what accumulated plus the current one 26, which gives you 78. Then 26,000 minus 7,800. What do you get? You get 18,200, I suppose. 18,200. 18,200. That's what you get when you take 26 minus 78. Then, this is our 2013, and I believe 2013 there was a machine that was bought. In 2013, yeah, you can see 2013 there's a machine that was bought, and you've been told a full year's depreciation for each machine is provided in the year of purchase. So it doesn't matter whether it was bought in November or whatever. 2013 will compute the full year depreciation. So 17 November 2013, 15,000, and the depreciation for this is 1,500. So let's capture it. So this is machine B. We'll come here and say 17th November 2013. It was bought at 15,000. The depreciation is 1,500. So accumulated depreciation, since it's still new and it has only survived for 1 year, is 1,500. So 15 minus that to get 13,500. That is the balance. 15 minus accumulated. So far, we still don't have machine C. We don't have machine D. We don't have machine E. So then here we'll go to the totals. You can see. Now totals will have 41,000. 26 plus 15. This is 41,000. 26 minus plus 1,500. That is 4,100. 78 plus 1,500. That should give you 9,300. And then 41,000 minus 93. That gives you 31,700. 31,700. If you add this to, you'll still get this. So that tells you the value of the vehicles at the end of the third year, which is 2013. So this is actually the importance, part of the reasons why an asset schedule is very important in an organization. You can see now we are able to know the total accumulated figure for that year, total value of all the assets for that year, like that. So we go to 2014. This is a good year. There was one more asset that was added on board. So it will present again a challenging bit of some challenging stuff there. So let's do this our drawings. Let's send our drawing. You'll forgive me for the crooked lines. I hope the point goes, you get the point. That is what is very important. It's the message that is very important. Just concentrate on the message, make sure you get the right message. And plot this good. So let's continue with 2014. It's quite a tiresome journey, but you need to be very fast. So 2014, which asset was added? In June, 47,500. This is asset C. So we'll show the cost and then continue with it, and the cost will just be the 47,500, and then continue with the working that we had indicated below. And that is started June 2014. The rest stand. Okay. So here we are. So date of purchase, cost, annual depreciation, accumulated depreciation, and then the net book value. So this is we retain the status quo, 26,000, 2,600. Now this will be 26 plus 7, 8. That will make it 10,4. So accumulated depreciation is 10,400. And then the difference now will be 15,600. We are taking the cost, this one minus accumulated depreciation. Then we go to the second one, 17, 11, 13. That's when it was bought. The figure was 15,000. Annual depreciation is 1.5. So accumulated depreciation 3,000, and the answer is 12,000. 15 minus 3. Then you come this one, which was bought on was it 1st June 2014? I think so. Let's just confirm. Figure it's 30th June 2014, 47,500. 47,500. So this is 30th June. 30th June, and the figure is 47,500. And now the depreciation. Now remember, for C, the depreciation was not constant. So these are the figures that we'll be picking. 8,500. So we picked 8.5 the first year. 8,500. And of course, we had already worked out the difference. 47.5 minus 8.5 gives us, it gave us how much? We had not got, so this one will give us, I think, 39,000. But accumulated depreciation is, annual depreciation is 8.5, so accumulated depreciation, because it's first year, it will be 8.5. So 47.5 minus 8.5, that gives us 39,000. So 39,000 like that. And we still don't have machine E and D. So when we come here, we simply add the 3, that was 41,000 plus 47,500. This gives you 88,500. So 88,500. Then the second part, that was 41 plus 85. That gives you 12,600. I'm just adding 12,600. Then we come to this other part, 10,400 plus 3,000 plus 85 again. That gives us 21,900. So 21,900. Then 88,500 minus 21,900. That gives us 66,600. 66,600. Sorry for that. 66,600. So if you add this, you'll get that. This is 51, 66, 600. Good. So we are done with our fourth year. Our fourth year we are done. So just underline to show that we are done with this part. So we go to 2015. I told you it's 20 journey. So 2015, how will our books look like? This is DP, cost, annual depreciation, accumulated depreciation, and net book value. So this is 2111, 26,000. This is 26. This will give us 13. Is it 12,000 or 13,000? 13,000. And so the answer will be 13,000. We are halfway. So this will be 17, 11, 13. This is 15,000 minus 1.5. Total accumulated is 4.5, 3,000 plus 1.5. And then that minus that, we get 10,500. Then for this one, it was bought in 3614. How much was it bought at? 47,500. What is the annual depreciation? Now this one you have to go back and check because it keeps on changing. So the second year it's 6.8. You can see second year 6,800. So we'll come here, pick 6,800. And then what is the accumulated depreciation? It will be 8.5 plus 6.8. 8.5 plus 6.8. That gives us 15,300. So 15,300. And then the net book value will be 47,500 minus that will give us 32,200. 32,200. That is the value of this car as at this machine as at this particular date. So we still don't have. Let me just confirm machine D and E. Machine D was bought in 2017, machine E 2018. So we still don't have them. So we continue. Machine D and E, nothing. So here the date, then we add 26 plus 15. This one will not change, so it will be 88,500. Then the depreciation will be 41 plus 68. That is 10,900. And then this one will be 13 plus 4, that is 17,500 plus 15,300. That gives us 32,800. So 32,800. That is the accumulated depreciation over time for all the three machines minus 88,500. That gives us 55,700. 55,700 is the value of these cars as at the end of 2015. So close that, close that. Yeah. Then we go to 2016. 2016, we repeat the same exercise. It's quite awesome. I wish we had, if we had an Excel to work this one, it would be done by now. Net book value, but since it's a learning moment, let's continue with the journey. 26,000, depreciation is 26. Annual accumulated depreciation will be 26 plus 13,000, which is 15,600. Then that will give us 10,200. Then this other side will have 17, 11, 13, 15,000. Then 1,500, then 6,000, this plus that, and then 15 minus 6, we have 9,000, like that. Then this one will have 36, 14. The total cost is still 47,500. Annual depreciation will have to come and check from here. It's 5440. 5440. So carry that 5440. Carry the 5440. And then, so it will be 47,500 minus 5440. I think this one is, no, sorry. We are looking now for accumulated depreciation. 15,300 plus that will give us 27,440. And then 47,500 minus 27,440. That gives us 26,760. 26,760, like that. So then let's get the totals. We still don't have this. The totals here will have, this one will not change because we have not added any machine. So this one can change. So 26 plus this, that is 341. 41 plus that one, that will give us 9540. And then add 15,600 plus 6,000 plus 2740. 2740, that gives us 42,340. So 42,340, and then 42,340 minus 88,500, that gives us 46,160. So this is 46,160. That is the value of the vehicles, or the machine, sorry, as at that particular point in time. So let's do that line and we close it. So we go to 2017. Don't get tired, don't get tired, don't get tired, don't get tired. You only get tired when you are assured of your marks. So we'll continue with this journey. We will continue with this journey. We will continue with this journey up to the end. Never say die. But you have to be very fast. This is a question that is trying to eat on your time. So you have to be very fast. It doesn't require a lot of thinking, as you can see, because it's more of repetition. But then you need to be very cautious of your time. need to be very cautious of your time. Very, very cautious of your time. Remember, you are being timed here, so don't waste a lot of time with this. Be very fast. This is a question that can eat on your time. Then you will not have a lot of time remaining to do other questions that can as well give you good marks. Remember, this question is only 10 marks, and being a 10-mark question should give you, at most, you should take 15 minutes on it. 15 minutes on it. That means that you have to be working at a supersonic speed. But we only have around 4 years to go. We are in 2017, 2018, 2019, and 2020. So we'll continue with our journey. And just something, 2017, there's a machine we acquired. Yeah, 2017, 2018. There are two machines we acquired, 2017 and 2018. So let's not forget that. So let's come here, DP, then cost, then annual depreciation, then accumulated depreciation, then net book value. This is 2017. So we still have that one maintains. This is still 26,000. This is still 26. This will now be 18,200 if I'm not wrong. And this will now be minus 26. Matrix is getting good here. 200. That gives us 7,800. So 7,800. This side will have 17, 11, 13, 15,000, 15, 75, 75. This side will have 36, 14. I'm just copying 47,500. Now, annual depreciation, we are supposed to go get the correct term here, the correct figure, which is 4352. That is therefore 4352. So 4352, then 4352 plus that, 4352 plus 2740, that gives you 25,092. So 25,092, then minus now the 47,500. You get 22,408. So 22,408. Now we are done with that. But remember, in our this 2017, this machine was bought 18,000. Depreciation is, so it was bought 10th May 2017 at 18,000. 10th May 2017 at 18,000, and depreciation is 3240. 10th May 2017. So 10th May 2017, the figure was 18,000 and depreciation is 3240, like that. Good. So of course, annual accumulated depreciation, this is the first year, so 3240. So 18,000 minus 3240 minus 3240, that gives us 14,760. 14,760. Good. Machine E you still don't have, so the totals. Now this time it will change, it will be 88,500 plus 18,000. That is 106,500. 106,500. I told you have to save time, so I'm just adding this figure, the total value of the assets, cost, plus this 18,000, and you get that. Then the depreciations, 241 plus 41 plus 4352 plus 3240. That gives us 11,692. So 11,692, and then we get the totals again here for the accumulated depreciation. That is 18,200 plus 75 plus 250.92 plus 3240. That gives us 540.32. 540.32. Then 106,500. 106,500. That gives us 52,468. 52,468. So 52,468. 468. That is the value of the assets as at the end of 2017. So this is 2018. We repeat the same thing: annual depreciation, accumulated depreciation, and net book value for 2018. So this is 2111, 26,000, 2,600. 26 plus this, you should get 2,800. And so the answer here will be 5,200. That is this minus this. I told you you need to work on your speed here, because this thing is not, it's time consuming. So unless you work on your speed, you might not get it right. Then 3614, this is 47,500. These figures are not changing. But now for annual depreciation, let's go back. Annual depreciation, it's 3482. Let's call it 3482. Let's call it 3482 to avoid working the decimals. 3482. So what do we get here? It is 25092 plus 3482. That gives us 28,574. 28,574. So this minus that, minus 47,500, get 18,296. 18,926. Sorry, 18,926. Then we have this asset here, 18,000. This is its second year, so the accumulated depreciation will be 6480. Just adding the two, this year and last year. And so 18,000 minus 6480, we will have what? 11,520. 11,520. Good. 11,520. Now this particular year of 2018, there's a machine that was bought. This machine is machine E. 9th October 2018, 110,000. 9th October 2018 at 110,000, and the depreciation is 19,800. So come here, we say 9th October 2018, the value of the machine is 110,000 and depreciation is 19,800. So we don't have accumulated for this year, so it's the same figure. And then it will be 110,000 minus 19,800. That gives you 9,200. So 9,200. Okay. So then what are the totals? Now we get 106,500 plus 110,000. That gives you 216,500. So 216,500. And then the total depreciation will be 41 plus that 482 plus 3240 plus 19,800. That is the annual depreciation, 3622. So it becomes very easy. These figures you can easily pick and cost them to the P&L. 2,800. I'm now adding the accumulated depreciation, that's 9,000 plus 28,574 plus 6480 plus 19,800. That gives you 84,654. 84,654. 84,654. And then now for the net book value, it's just that minus 216,500. And we have 131,846. This is the value, 131,846. So we go to 2019. Hope we are moving. You can see we are moving well. So we only have 2 years remaining. Good for us. So DP cost, accumulated depreciation, annual depreciation, solely accumulated depreciation, and net book value. So do you have here 2111, 26,000, 26, 23,400, 23,400, and the value that is remaining is 26. Then here we have 17, 11, 13, 15,000, 15. We add that 10,5. What we have is 4,5. Then we come here 36, 14, 47, 500, 34. Oh, wow, this one is not 3482. You see, that's the speed you're supposed to be moving at. 3482, 2785. So say here 2785. 2785. So 2785 plus that, 2785 plus 28574. That gives you 31,359. So 31,359 minus 47,500. We have 16,141. 16,141. Then you come here 10,517. This is 18,000. Depreciation is 3240. This will give you 3240 plus 6480 plus 6480. That gives you 9720. So the depreciation, annual depreciation, accumulated depreciation is 720 minus 18,000. That gives you 8280. Then this one will be 9, 10, 18. It was bought at 110,000. The annual depreciation is 19.8. The same because it's straight line method. So 19.8 plus 19.8, that should give you 39,600, I suppose. Yeah, 39,600. So 39,600 minus 110,000. That gives you 70,400. 70,400. Like that. Then let's get the totals. Totals, this one will not change. So 216,500. This one will change. And again, if you know, the only thing that is changing here is this. So you can safely take this minus this plus this, and you will have your answer. But let's just go the longer way. 41 plus 2785 plus, because we are looking at saving any little time that we have, plus 19,800. That gives you 29,925. So 29,925. What I was telling you, let's take this figure. Are you seeing this? 3622 minus this one. So this is the only figure that is changing. That 482 plus this figure that we are introducing, this one. It's the only figure that is changing. 27,885. What do you get? 29,925, the figure that we have here. So you can, that's how you can basically shorten the process. So let's get the accumulated depreciation. 23,400 plus 10,500 plus 313.59 plus 97.20 plus 39,600. That gives us 114,579. 114,579 minus 216,500. This should give you 101,921. 101,921. So then we go to 20, which is our final here. Wow, it has been a journey, but thank God. Cost, annual depreciation, accumulated depreciation, and then net book value. So this time round, I think I can just do my own lines here. I hope I get them right. Oh. Yeah. Okay. We are done. So this is 2,111, then 26,000, then annual depreciation is 2,600. So accumulated depreciation here is 26,000. Adding this 23,4 plus 26 for this year. So net book value 0. So this asset is no more. Then this other one, 17, 11, 13, it was bought at 15,000. Annually it depreciates at 1,500. It has accumulated to 12,000. The balance is 3,000. It has 2 more years to go. Then this one is 36, 14. It was bought at 47,500. Annual depreciation this year is this is which year? 2785. So we come here 2785, 2228. So 2228. And then accumulated depreciation. Accumulated depreciation will be 313.59 plus 22.28. That gives us, sorry, not gotten that one right. 313.59 plus 22.28. That gives you 33,587. 33,587. So 33,587 minus 47,500. This gives you 13,913. 13,913. Like that. So 13,913, come here. That's the value of that asset as at that particular time. Then 517, 18,000. This is the other asset. This is the annual depreciation. Now the accumulated will be 3240 plus 9720. That gives us 12,960. So 12,960 minus 18,000. This gives us 5040. Yeah, 5040. So 5040. Yes, it's 5040. Let me see something. There was something about it. Oh, there was 1,800. So 5040. You can see next by the end of the following year, it will be 5040 minus the 1,800. So we only have 1 year to go for this asset, and we have actually depreciated it for 4 years. So the 5th year it will be normal, and it will still remain with the salvage value of 1,000. Once you less 3,240 from this, will have the salvage value of 1,800. So it makes a lot of sense. Now let's look at the last one. This is 9, 10, 18, and it was 110,000. The annual depreciation 19.8. So this one will give us 19.8 plus 39.6. That gives us 59,400. So 59,400 minus 110,000. That gives us 5,600. 5,600. So then 5,600. So come here, the totals. This one will not change. 216,500. Let's get the total here. So this will be 41 plus 2228 plus 3240 plus 19,800. That gives us 29,368. 29,368. So for the accumulated depreciation, in fact, for the accumulated depreciation, instead of going all this way, the best way, easiest way is just to add this. Let's take an example of this, and then you add this. If you add that to be 84,654 plus 29,925, you get 114,579. This one. Are you seeing how it goes? So instead of adding all these things, just take 114,579 plus 29,368. So that you save time. This question generally is time consuming. So unless you come up with strategies to save time, you will lose on time. And when you lose on time, will be disastrous. This is 72,553. This is the final figure as at 20th. As at 2020, this is the value, net book value of all the 5 assets, but this one has depreciated completely. These ones are still there, and this is their value, the net book value. This will be the cost, the annual depreciation, the accumulated depreciation over time, and this is the net book value. So that's how it goes. This is an asset schedule, and it basically shows the value of the assets, cost, value of the asset, depreciation for each and every year. So that's it. This question is 10 marks. Check on your speed. Doesn't require a lot of thinking, but it's the speed that counts here. So thank you. Welcome. Continue following us. And success. Thank you.